Hey everyone, this is Logan Hertz with Hazeltine LLC. I have Peter Nelson of Nelson Insurance Advisors with me. Peter, how you doing?
Living the dream, Logan, living the dream.
We are continuing our financial malpractice series with another real life case. This one a bit more high profile of financial advice being given out publicly in a public forum that when we get to the actual financial advice, which will take a bit, I consider this to be a form of malpractice because quite frankly, what's being recommended is terrible advice, and the recommendation is given without even bothering to look into the client's situation. It's just kind of a blanket do this without bothering to even, it's like giving a diagnosis and a treatment plan without bothering to examine the patient, right? The
Right.
patient just says, my arm hurts. Oh, you have cancer. Do chemo. Here it is, right?
Yeah.
And so what the clip in question is a Dave Ramsey clip. Let me start by saying I have a lot of respect for Dave Ramsey. I know people personally who have benefited tremendously from his system. He's helped a lot of people get out of toxic debt. That's what he's best at. I've got a lot of respect for anyone who can be a successful entrepreneur like he has. That is really hard to do. He's been through the brutal process of declaring bankruptcy and crawling his way out of this debt. So he knows what it takes. And he gives, I think, great advice to the people that he typically talks to. And I wish he would stick to what he's good at. If he would stick to what he's good at, there wouldn't be much of a problem. Right, Peter?
Yeah. No, it's all about staying in your lane. And this is what you find out about these financial gurus, I think, is that they try to be a jack of all trades. When a client immediately says to me, "Oh, I follow Dave Ramsey," I say immediately, "Oh my gosh, that's amazing. All the, way he gets people out of debt, lives within their means, but also isn't it true that he speaks in generalities because he's got this huge national audience. And what if the information that he gives out is good for the majority of the people, but what if it's not best for your situation? If Dave Ramsey was actually here, wouldn't he want you to actually do what's in best for your situation? Would you like to do the math?" And they always go, "Yeah, that makes sense." Because let's face it, Logan, we deal with probably the top 10% of Americans, right? For the most part, we deal with higher net worth clients. Let's be honest, a lot of the time, right? And isn't it true that, Dave Ramsey for the most part is typically talking about people on the lower spectrum. So, and Dave Ramsey is an amazing marketer, but I think the one thing that people got to realize um, is that he's also created quite a bit of financial malpractice, we could say at times. And as a matter of fact, I don't know what the situation of it is recently, but it was in the Tennessean newspaper recently that he was being sued for $150 million due to deceptive marketing practices. I don't know where that's gone. I haven't heard anything about it recently, but so there's I would say the good, the bad, and the ugly of Dave Ramsey.
Yeah, let me just respond to one thing you said, Peter. I have clients who are very middle class. The infinite banking concept really is for anyone who uses a bank account. I do have clients on the higher end as well. So I don't think my practice is like that. I will say that it's not so much a wealth gap as it is a mindset gap. I will say that a lot of my message just ends up finding more receptivity among people who have higher incomes and who have more wealth. But it's not the fact that they're wealthier, it's their mindset is different and they're able to recognize value, I think, a lot more readily than other people who may not be. But I have clients who are squarely in the middle class who not at all in the top 10%, still want to become their own bankers. It's really more about the mindset for my clients than it is, an asset level or anything
Yeah,
like that.
but and let me clarify real quick. And I'm glad you mentioned that because that's true with my clients too. But I don't know if you knew this, but the chief actuary of Social Security says you're in the top 10% if you make $100,000 a year per person. So let's face it, there's a lot of people that we consider in the middle class today that are making $100,000, and they would not consider themselves to be in the top 10%. But honestly, they are. So I think if we look at it from that perspective, um, but then, I have clients that make less than $100,000 a year, but anymore with this inflation, the way things are going, it's really, I remember 20 years ago in this business, making 100,000 was like a big deal, but now it's like, you got to make 100,000 to scrape by anymore, it seems like.
Yeah. Okay. Well, let's jump into this clip. I'm going to skip some of the beginning so we can try to get to the relevant sections quickly. And I'm just going to share the audio. It really is more audio than anything else. We'll share the actual video if you want to watch the actual video, but I'm just gonna play the audio here.
25 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you sort of say that you didn't think they were a great investment, but I haven't really heard you get into any details about
He's talking about whole life when he said not a great investment. There's a whole life policy.
why you think that is. So I was wondering if you could just talk about that a little bit, and maybe I'm missing something, and if I am, I'm sure you'll.
Okay, I'm not sharing the video, but it says on the screen, why is whole life not a good investment? Here we go again. Okay, like DeAndre Clayton says, one of the ways you can tell someone doesn't know anything about a whole life is they'll say whole life is a terrible investment. Yeah, whole life is not an investment. Okay, we've got to get this straight. We've got to classify it properly.
Yeah,
okay, whole life is not an investment. And by the way, I also want to say the title to the video is Why Dave Ramsey Hates Whole Life Insurance. And hates is in all caps. So do you want to get financial advice from someone who has a knee-jerk emotional reaction to a financial product? I mean, this guy is a marketing genius. So probably that's good marketing to have the word hate in all caps.
And
but I don't know that it's good financial advice, right?
Right.
It's emotion. Right?
And let's be clear, who's also another brilliant marketer? Ken Fisher, right? I hate annuities, and you should too. They've both become filthy rich off of saying stuff that is absolutely financial malpractice, and it's
good marketing though.
Yeah, and they've both been sued for it. But you know what? When you make as much money as they do, what does it matter if you get sued a couple times? I mean, look at Ken Fisher. He's been sued for all kinds of things, right?
Yep. And to your point, Peter, I want to make an analogy here. You say they mischaracterize it as an investment so that they can trash it. And I think they may not even be deliberately mischaracterizing it. I think they're just so locked in this return on investment framework, they can't think any other way. But them criticizing whole life as a poor investment, that's like me criticizing mutual funds because it doesn't have a death benefit. It doesn't cover you for long-term care. It doesn't come with critical illness insurance, right? I mean, it's kind of the same thing. And honestly, those are limitations of a mutual fund. A mutual fund doesn't have a death benefit. It doesn't cover you for long-term care or critical illness. Whole life does all of those things, right? But I would not criticize mutual funds because they don't have a death benefit, because they're not meant to be life insurance, right? They're investments. They serve a different purpose, right?
And I know you. I'm pretty sure you know this, Logan, but a lot of people probably don't know this. Dave Ramsey owns whole life insurance. Okay, he owns whole life insurance himself, but he doesn't believe, and he said this, he doesn't believe the average American is smart enough to actually understand it. But here's the thing, though. When you buy it, I own a truck. I'm not a mechanic, okay? I just put the key in. I know how to drive my truck, but I don't know how my whole truck works. That's what he's pretty much saying is you should own whole life insurance without even getting into this. But he's saying that he doesn't believe Americans should own whole life because they don't know how it works.
So. Yeah, they don't know how mutual funds work either. But right. Okay, yeah, let's continue. All right, so the question: why is whole life not a good investment? Okay, that's
it's not an investment. So never has been, never will be.
You'll hit the point.
Okay, sure. Well, the overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x.
Okay, this is one of my big pet peeves. Whenever someone starts throwing out numbers, be very suspicious. He starts by throwing out a number without telling you where that number came from, how it was calculated, what it means, what are the assumptions behind it, because now that makes them sound definitive, right? They use numbers and data as a replacement for actual arguments. So what he's saying is, roughly 20x whole life versus term premiums. Okay? This isn't just wrong. This is completely incoherent. This is an incoherent statement. Just like the financial advisor in our previous financial malpractice series, he's saying things that are incoherent because he does not understand how whole life works. This is like saying, Peter, real estate costs $20 a square foot. That's not a coherent statement. You can't talk about real estate in the abstract like it's one amorphous blob. You cannot talk about whole life like it's one amorphous blob. I can design it any number of different ways. So what real estate costs per square foot can vary tremendously depending on how you design it, where it's located, right? All those kinds of things factor into that. And so let's bring up some real numbers. So if we're going to talk numbers, let's bring up some actual real numbers. So just for fun, I did a couple of quick illustrations, and this did not take me long. I could have played with this a lot more and made these numbers vary a lot more wildly, right? Okay, so let me share these illustrations I made, which are with the same company, okay, and with the same person. So this 35-year-old male in good health, right? Okay, can you see my screen, Peter?
Yep.
Okay, excellent. All right, so he says whole life costs 20 times what term costs in terms of the death benefit. Okay, same company, same everything. 35-year-old male with the best rating. In this policy, Peter, you pay in a $10,000 premium and you have a $229,000 death benefit. Okay?
Yep.
Now let's look at a different policy. Same person, same premium. Okay, here's the other policy on Mr. John Smith. We pay in $10,000 and we have a $781,000 death benefit. More than 3 times what that original death benefit was for the same premium, and it's all whole life. So you cannot categorically state that the death benefit in whole life costs X. It costs whatever you want it to cost. And I can make this vary a lot more widely. I'm only looking at one company. I didn't spend a lot of time in case design.
Yeah.
So
No, I mean,
saying that the death benefit costs X is like saying that this real estate square costs X per square foot. It's not a coherent statement. Right?
No, once again, this is what these financial gurus do. And it is financial malpractice. I want to be clear. Because you cannot do generalities like this. And this is the way he's destroying people's financial picture by doing this. Okay.
And again, I think it's important to reiterate how ignorant these statements are, right? So when people throw out authoritative, definitive statements, you know they don't know what they're talking about, right? People who really know what they're talking about are much more nuanced in their language, and they're much more careful with what they say, because invariably there are nuances. They don't throw out dogmatic, categorical statements, and they certainly don't throw out a number without explaining what are the assumptions behind those numbers, how is it come up with, right? So Dave Ramsey, and he's not the only one who does this, a lot of people do this, throws out a number as if that's going to shut down debate because the number is definitive. Well, hey, I can make up numbers all day long. So I don't know where he got that number from, but it's clearly wrong. And not only is it wrong, it's incoherent. It's an incoherent statement, right?
Yeah. Well, here's another one, Logan. What's just curious. I don't know if you worked one up. What's $1 million term on a 35-year-old? I don't know if you.
No, I didn't bother working it up.
Well, I would be curious. I mean, it's probably.
And you can't talk about term like it's an amorphous blob either. There's term, there's convertible term,
Right.
There's convertible term with living benefits, right? Depending what company you're with, depending on how you design it, you could add child term riders, you could add other various riders, you could add accidental death benefit riders. You can even term has some flexibility in how you design it. It's simpler than whole life. But yeah, I just want to reiterate that talking about whole life in the abstract, like it's one amorphous blob, is like talking about real estate. You can't make a coherent statement about real estate in general, about what it costs, right? And it's also trying to boil everything down to one metric. Now, you would look at this and say, oh, this policy is better because we pay the same premium and we get more death benefits, so this policy is better. No, Okay, we can use whole life for a lot of different reasons. Okay, this policy may not be better or worse, right? Notice we pay this $10,000 premium. We get a much larger death benefit, but we have no cash value. We look at this other policy, we pay that same premium, we get a much lower death benefit, but look at how much cash value we have in year one. Depending on what our goals are, either of these policies could be the right policy for you, right? There's no one right policy in the abstract. And asking how much does the death benefit cost is an irrelevant question. It's like looking at real estate and just narrowing everything down to what's the cost per square foot, as if that was the only metric that mattered.
Yeah.
Right.
And by the way, did you hear the numbers that this guy said? It was $600 a month for $1.5 million of coverage. Was that the correct?
$680. I believe that was correct. $680 a month. And the guy in the video winced like, "Ooh, that's bad," because again, it's never about the value that's being created. It's just about the cost, right? No question as to what that 680 is getting you, right?
Right. I mean, honestly, and I know now. We don't know how it's what the company is, how it's structured.
Mm-hmm.
It might be non-participating whole life, but that's a pretty good price. If I could buy right now, if I could buy 1.5 million, and I might be able to, but I'm just saying $680 a month for 1.5 million a whole life that's guaranteed to never go up ever. That's not bad. And if that
never go down, I think you meant to say guaranteed to never go down.
Well, I mean, guaranteed.
Oh, you mean the cost is guaranteed to never go up?
I mean, the cost is guaranteed to never go up.
Right. Got it.
Yeah. So, and if that comes with a chronic illness rider to help offset a long-term care event, oh my gosh, that's a deal. Sign me up.
Right. Yeah. Another thing you'll see as we go into it is he doesn't get into any details on any of it. Right. Doesn't even bother examining the patient before he gives his diagnosis.
Yeah, that's the thing is he's not asking, well, we need to talk about what this is, how it's, no,
yeah,
we're going to talk about
what, right. What company is it with? How's it structured? Why did you originally take it out? None of that. Okay.
And ladies and gentlemen, this is why he's unlicensed, because unfortunately in the United States of America, and I guess it's good, we have free speech, right? But here he's allowed to spout financial.
Yeah, I don't begrudge him. Running his mouth. I mean, I don't want to put a gag order on other people. I want to just do what we're doing. So, okay, we'll just respond to what he's saying.
Yeah.
Okay, let's move on. All right.
Okay. And for the insurance, obviously whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup.
Okay, this is again an incoherent statement. Okay, he says whole life has another component, cash value. No, cash value and death benefit are not separable. Okay, Dave Ramsey and a lot of people who don't understand whole life, they treat it like it's two completely different things. Like you've got death benefit over here, and then you've got cash value over here. No, that's not true at all. Any 3-year-old would ask the question, why? Why is it that term life insurance has no cash value, whereas whole life insurance does have cash value? No intellectual curiosity as to know why that might be the case. It's just this random component floating out there that somehow it has cash value. No, cash value is the net present value of the future death benefit discounted for future premium payments. I won't go into all of what that means, but the point is, the reason why a whole life insurance policy grows cash value, whereas a term life insurance policy does not, is basic financial principle. A future payment has a present value. Okay? More than 98% of term life insurance policies, that death benefit will never pay out. So it has no present value. With a whole life policy, that death benefit is guaranteed to pay out. So it has a present value. Let me also state, too, it's important to point out, he uses the word life insurance. I prefer the word death benefit. Because when you buy whole life, you're not buying life insurance, you're buying a death benefit. Even if whole life had no cash value whatsoever, it would still be more expensive than term. You know why? It's a guaranteed payout. When you take out $1 million of term, it almost never pays out. And you don't want it to pay out. The only way it pays out is if something bad happens. You die prematurely, which you don't want. Okay. With whole life, you're purchasing $1 million legacy, right? If you live a long, fulfilled, healthy life and then you die peacefully in your sleep at age 95, that $1 million death benefit, which will probably have grown to 3 million by that time, will now pay out tax-free to your heirs. Okay. That's not a negative, that's a positive, right? So you're not purchasing life insurance. You purchased a death benefit that will be paid. So you cannot say 1 million of term equals 1 million of whole life, even if there were no cash value, right? They're qualitatively different. Qualitatively different. Getting back to a real estate analogy. It's like saying, well, I've got a $2,500 square foot house here and a 2,500 square foot house here. It's like, no. The term is equivalent to a 2,500 square foot tent. It's just a tent. It's a temporary structure, okay? Whereas the whole life is a 2,500 square foot house. Wouldn't that cost more than a tent? Yes, because it's a permanent structure that you own, that you live in, right? Whereas term is temporary, and you're never going to see that $1 million death benefit. And you hope you don't see it, right?
Right. And you've probably heard me mention before, but Penn State, where I went, they did a study years ago, and they found out that less than 2% of all term policies pay out. And you're absolutely right. You don't want a term policy to pay out. But in over 21 years, I only ever had one term policy I ever wrote pay out. But you know what? It was for $1.2 million payment. Someone in their mid 30s. So you're right. You don't want them to pay out. Something bad happens if a term policy pays out for the most part.
Yeah, and also, again, even if there's no cash value, there's a qualitative difference between a term life insurance policy and a whole life death benefit. What about the long-term care protection? He didn't mention that, right? You can advance yourself that death benefit in whole life should you have a long-term care need. What about if you have a critical illness? Some whole life policies, if you have a heart attack, stroke, cancer, you can start advancing yourself a portion of that benefit. There are even some whole life policies that you made me aware of, Peter, where there's even a disability on top as well. So if you need disability, if you're disabled and unable to work, you can start advancing yourself a portion of that death benefit, right? Yeah. So there is a qualitative difference. You cannot act like 1 million in term and 1 million in whole life are the same. They are not the same, even if there were no cash value. Okay, and again, cash value and death benefit are not separate. It's not like you've got them floating off in the ether. He clearly doesn't understand how whole life works. Right?
And I just want to mention real quick, hopefully a lot of people know about Dr. Wade Pfau's safety first planning. He talks about having a buffered asset in retirement. It'll actually allow in the bad years you use the buffered asset to pull for retirement income so that your investments can claw back. And Dr. Wade Pfau proved in the book that if you do that, your funds will last a lot longer. So once again, did Dave Ramsey say, are you planning on using this as a buffered asset? I can guarantee you that Dave Ramsey and this guy do not understand what a buffered asset is. Okay, and that's a shame because your retirement, if you have a buffered asset, it's highly likely you're going to run out of money in retirement a lot sooner.
Right. There's, like we discussed, it's no way. Okay, what company is the policy with? How's it structured? Why was it taken out? Let's take a look at it. No, it's bad. It's all bad. I'm not even going to examine it. It's all bad. Okay. All right. Let's move on a little bit. I know we're maybe running out of time. Let's see if we can get a little bit more in.
Got about 5 minutes, and we'll go to part number 2 because
the cash value build up is the other $95 out of $100 approximately.
Again, that's an incoherent statement. What he's saying is for every $100 you pay into whole life, $5 goes to death benefit and $95 goes to cash value. That's an incoherent statement. Death benefit and cash value are not separable. They are not two different things, right? That's a totally incoherent statement. Again, cash value is the net present value of that future death benefit, right? And let's go back to the policy that I showed you, okay? Let's look at this policy again, just to drive this point home that, you can't talk about whole life like it's one amorphous blob, okay? In this policy, in year 1, I pay in $10,000. There's no cash value. There's no cash value. So according to Dave Ramsey, all of it went to death benefit. Well, no, that's not how it works. Okay. In this other policy, we pay in 10,000 in premium. We have a lot less death benefit, 229,000 as opposed to almost 800,000, but a lot more cash value. We paid into $10,000 premium. We have more than $7,500 worth of cash value. So again, these are incoherent statements, right? Death benefit and cash value are not two different things. And how much death benefit and cash value we have depends. I can structure it however you want, right? We can do it a lot of different ways, right? So he's making categorical statements that are they're not just wrong, they're incoherent. It belies a fundamental misunderstanding of how whole life works.
Financial malpractice.
Well, the financial malpractice will come later when he actually makes the guy a horrendous recommendation. And I can't even necessarily say it's a completely horrendous recommendation. If he had actually gone through the details first of the whole life policy, the recommendation he made, I will grant for the sake of argument, may have been the right one. But you wouldn't know that until you've actually looked at the policy,
So,
right?
no.
You can't tell me a piece of real estate is a piece of trash if you've never seen the property. You don't even look at it and just say real estate's terrible, get rid of it.
Yeah. Once again, and we'll wrap this up, but if you're paying 680, and that's structured right, and you're getting $1.5 million of death benefit. By the way, I mean this is another thing going back to buying whole life. The sooner you should be. I mean, hopefully people are buying whole life for a newborn, because I can, just for example, because I've been doing so much of it lately, $250 a month buys a newborn roughly $918,000 of death benefit, and by age 60. You're going to have $1 million of cash value and $2 million of death benefit. You only paid in $180,000. That doesn't sound like a bad deal to me, right? But what
Right.
he's
And
telling
those numbers could vary wildly depending on how you structure the policy, right?
right? I'm just talking about plain Jane. I'm not talking about max PUA. I'm just talking plain Jane
Right.
stuff right out of the box.
Right. I could structure the policy very differently, and the cash value would be significantly more, but the death
Yeah.
benefit would be significantly less.
Yeah.
Depends, right? I've structured policy. I could have brought up another policy that I structured completely differently because it was structured with the primary purpose was long-term care protection, right? So there's less cash value and less death benefit than you would typically expect for the amount of premium being paid in, but that's because the long-term care protection is a lot more robust, right? So you can't say, oh, it's a bad policy because the death benefit costs more. No, what the death benefit costs is a function of how we design it. That's like saying this real estate is terrible because it costs more per square foot. Well, it might be a better piece of real estate. That's why it costs more, right? So again, and you can't separate cash value and death benefit. So to say that $95 goes to cash value and $5 goes to death benefit is not a coherent statement. That's not a coherent statement, right?
Yeah, it's pretty ridiculous. And this is, like I said, he does great, gives some great advice in regards to, getting out of debt and all of that. But this is where it's like the other side of him. And if he would just stay in his lane, I would be, but it's like this Dr. Jekyll, Mr. Hyde kind of deal. It's a shame.
Yeah, there are just 2 points. I know we're running out of time that I want to reiterate. Number one, when people start throwing out numbers, be suspicious. Okay, numbers and data by themselves mean nothing. It's where did the numbers and data come from? What were the assumptions behind them? How were they calculated? And how do you interpret those numbers, right? You see it in politics. You see two people on opposite sides of the spectrum, and they throw out data and statistics that seems to completely contradict each other, right? Also, you'll sometimes have two completely qualified experts in a field looking at the exact same set of data and coming up with wildly differing conclusions, right? So when people throw out numbers and data, what they're typically saying is, I don't really have a coherent argument, so I'm just going to throw out a number to make it sound definitive, right? But the question of where did that number come from? How is it calculated? Why is that the right metric? How do I interpret that number, right? And then the other point, again, is, like Peter has said, A lot of these financial gurus who act like they know all this stuff and have large platforms and all these experience and credentials oftentimes can be pretty ignorant and pretty blind to some of the most basic financial concepts in areas where they're not an expert. If they just stick to their actual area of expertise, they're great. But when they start wandering off the reservation in other areas, and again, the more dogmatic and definitive they sound, the more you can be sure they probably don't know what they're talking about, because it's usually not that simple, right?
My best analogy, Logan, and then we got to wrap this up, is Dave Ramsey is like at times talking about whole life. It's like a proctologist talking about brain surgery.
Mm-hmm. Mm-hmm.
It doesn't make a lot of sense.
Mm-hmm. Yeah, yeah. And on that note, we've got more to come, of course. But I hope you guys enjoyed this episode. I hope this is educational, and we're going to continue to do this because I think it's got some great traction. I think people are learning a lot, hopefully, from this sort of character foil we are using to show what may be where the limitations of sort of the standard conventional wisdom may be, and where Peter and I can present an alternate approach that may be worthy of consideration. So thanks, Peter, so much for your time and input. I can't wait for the next one.
Thanks, Logan. I enjoyed this so much. God bless. Godspeed.
God bless.